Hello, folks. Good morning. Welcome to a new episode of GSN Invest. In this episode, we'll be tracking one sector that has seen a lot of headwinds and pressure lately, that is IT. And more specifically, we'll be looking at the top five ratios that you need to track, ratios and operating metrics that you need to track in the Indian IT sector to develop a good understanding of any of the business and see how it is kind of performing on a quarter to quarter basis or even on a long term basis as such, right? So the way we structured it is we'll speak on each ratio individually, tell you how to kind of track that ratio and why that is important or why that is relevant in tracking a sector like the Indian IT space, right? So the first ratio that we'll track it, and this all of these will be like a combination of either a single number or one or two numbers broadly in one business area, right? So the first two that we'll be looking at is the total contract value, right? So total contract value is the value of the contracts that you've won in any particular quarter. And in the Indian IT sector, especially, this is extremely critical because in a business we always want to have a forward-looking metric, a metric that will give us a good idea of how the business will be like a few quarters down. And because in the IT sector, you typically win a contract that you will execute over the next, say, 4 quarters, 6 quarters, order. So, having a good overview of how you're able to kind of consistently win contracts gives you a good idea of how the business can be in the next few quarters to come, right? Another ratio, which is just an adjacent ratio to this, is the book to bill, right? And what book to bill is effectively the ratio of the contract that you won in any particular quarter divided by the revenue that you've recorded on your books in any particular quarter, right? And ideally, your book to bill should be above one. The greater, the better. And similarly, on your TCV, on the total contract value, the higher your TCV is and the faster it is growing, the more healthy the sign, right? The more healthy the business, because effectively you have greater visibility on longer term revenues as such, right? The second key metric that we will track, and this is kind of common across a lot of businesses, but more relevant to IT in the current context, is the operating margin, right? Operating margins are obviously important in any line of business that you're tracking, but in the current context, is especially important because of the strategies that a few of the companies are using, right? So obviously, in an environment where growth is a bit challenging, there are two routes you can go through, right? You can accept that the market is a bit challenging, growth will be a bit stagnant, and take a hit on growth, or the other alternative that you potentially have is accept that you are in a relatively lower growth environment, but continue your growth focus. And if you want to kind of continue growing, the way to do it is take a hit on your margins, right? So offer kind of relatively better deals to your end consumers that will kind of be able to push through your deals faster. You'll be able to kind of secure deals faster, but obviously at the cost of a hit on your margins as such, right? So we've seen two types of companies kind of emerging out of the current move. One where companies have proactively taken a hit, and there'll be various ways they'll kind of disguise it, right? So one is they'll say to kind of protect their long-term strategic relationships with clients, etc. They are taking on part of the cost impact and stuff like that, right? So various ways to position it, etc., to end investors, but broadly, uh, companies will have to take a hit on margins to kind of protect their long-term growth as such, right? So tracking operating margins, tracking the trajectory of operating margins always gives you a good indicator about the kind of strategies companies are using to grow their business as such, right? So that's the second key one that we wanted to focus on. The third key one, especially if you are, say, focused on a relatively niche part of the market, like say the ER&D space, is the mix of your revenue that you have, right? And why this is important is some of the businesses in the Indian market, some of the ER&D businesses in the Indian market are focused overwhelmingly on the mobility space, and even in the mobility space, overwhelmingly on the auto space, right? And the auto space, as you would all know, has kind of faced challenges over the last few quarters. That continues in Q1 as well, and based on the guidance and the conference call comments from a lot of the key managements, that will likely continue at least for the next 3-4 quarters or so, right? So at least for the rest of FY26, that sort of a pressure will continue. And as a result of that, businesses which have an overwhelming presence of their revenue coming from just the auto segment will be disproportionately hit, right? And we've seen in the ER&D space there are at least 2, 3 businesses which have a lot of revenue coming from that one space. As a result of that, those businesses can be at a higher risk in a market like this, as opposed to businesses which have a more diversified kind of lines of business, right? So we have other ER&D businesses as well, which are relatively kind of better diversified in terms of revenue, as a result of which the hit to their books is relatively lower, and so the larger IT companies, etc., have a relatively diversified business as well, right? So having a good understanding of the revenue mix, and more importantly, the concentration on any one particular sector, right? So if one particular sector is 70%, 80%, 90% of your overall revenue, that puts extreme stress on your business in a relatively weaker market environment, right? So revenue mix and concentration is something that you need to track. Then we come to the fourth ratio, right, which is your employee count and employee attrition, right? So basically your employee growth sort of metrics. Why this is important to track is because obviously IT services that we have, especially in the Indian context, right? So we do not have a lot of product sort of companies. A bulk of our IT companies, at least the larger ones, are pure play IT services sort of companies, right? And in that sort of a business, your growth will obviously be a function of the kind of employees that you have on your books, and sometimes the way the management's guide as opposed to the way they are hiring is not always in sync, right? So companies could guide you that we're looking for, say, double digit growth or slightly higher growth over the next few quarters, but when you look at the employee counts that they have, that necessarily isn't growing as fast, right? So that could be a sign that the management's actual view on how business could scale up over the next few quarters might not be that positive, right? So typically, when you see a relatively sharp spike in the headcount that any business has, that's likely a good indicator that that IT business could be relatively bullish on the near to medium term trends as such, right? At the same time, attrition again is important to track, because if you enter a period of very high attrition, that pushes up your employee costs and consequently takes a hit on your margins, right? So in the last bull cycle that we saw for IT, we saw the attrition numbers that kind of spiked tremendously, going past 20% as well. Those have now started to moderate, right? So tracking both the growth in your employee count as well as the attrition numbers are always helpful to get a view of what's happening in the sector and at what stage of the sector cycle you could potentially be in, right? And the last number that we'll track is your revenue per employee, right? And the revenue per employee tracking is important for multiple reasons, right? One is you'll notice a very clear difference in the revenue per employee that you can get for different types of businesses, right? So a traditional bread and butter sort of IT services company will typically have a slightly lower rev per employee. At the same time, if you look at something like an ER&D company, a more specialized IT services business, the revenue per employee there will be substantially higher, right? So, one, just by kind of gauging the number, you'll be able to tell whether the kind of services that they're doing are relatively mechanistic or require some degree of higher expertise. The second very important reason it becomes to track this number, especially in the current environment, is that a lot of businesses have been guiding that incrementally your revenue could not be very, very proportional to employee growth, right? So traditionally what used to happen is that the incremental growth in your revenue per employee wasn't kind of too fast, as a result of which a bulk of your revenue growth was in line with your employee growth, right? So you, if your business was growing, you would hire more employees, keep them on your staff, keep some of them on the bench, etc. as well. And as your business grew, the utilization of that workforce, etc. grew, right? What is increasingly happening with the advent of AI, with companies moving towards more efficient sort of businesses, is that businesses have been able to push growth on the same smaller employee base, right? And this was typically not seen too much in IT. And as that starts happening, tracking the rev per employee number becomes even more critical, because you'll be able to track whether the business is actually able to deliver a greater improvement in efficiency as such, right? Because a lot of times the kind of statements managements make in calls, etc., are a bit frivolous, right? They'll quote X number of employees who've got trained in AI, certified in AI, etc. But if you are operating on a minuscule rev per employee number and that's not really growing much, uh, the numbers that you're stating are probably just them doing some basic AI test or something like that, right? Which is not kind of too valuable, right? So tracking the revenue per employee number and tracking how that grows will give you greater insight on the quality of business that the company is running and how well that is growing as such, right? So that was it for this episode. We hope it added value. We are receiving a lot of questions, DMs, etc., regarding the IT space. So we'll be doing another episode. We'll be comparing three of the interesting IT companies, the ER&D companies, and their results for this quarter. So if you do like that, please do subscribe to our channel to get notified as and when we come out with future episodes. And if this episode added value, please do share it. Please share it on your socials, on your groups, wherever you're possible. Because we are a relatively small channel now looking to grow, and your support in this regard will be very, very helpful, right? Thank you so much. Thank you for your time, and we'll see you guys next week.